Hey guys, Jay Sini here from Australian Wealth, and today we're going to be looking at a question that's on the edge of every single person's lips. Is the stock market overvalued? Alright, so here we are in July 2020, and valuations of stocks have gone up dramatically since the March lows. So at this point, I don't think it's good enough to just look at valuations and go, oh, the stock market's gone up heaps. Clearly, it must be overvalued. So I think the best thing to do is actually get into the data and have a look. Now, as usual, I'm not a financial advisor. This is not financial advice. You need to make your own decisions when it comes to investing. So the first metric that we need to look at is if you have smashed the like button and subscribed to the channel. It's really important. It helps to get this video and this information out to more people. So if you could do that, that would be fantastic. So anyway, there's a few different metrics to judge on whether the stock market is overvalued or undervalued. So the very first one that we're going to look at in this video is called the Buffett indicator. So what this indicator is it's the market cap of the Wilshire 5000 to GDP ratio. So the market cap of the Wilshire 5000 is the top 5,000 companies in the US and looking at what their valuations are currently at and then comparing that to the gross domestic product of the country. So once you take the top 5,000 stocks and then divide that by the GDP, you times by 100 to get the percentage. So this is an indicator that Buffett likes to use to determine how frothy valuations are. So historically, this indicator trades at around 75%. Sometimes it's been lower and sometimes it's been significantly higher. So over 75% is starting to lean more towards overvalued, and below 75% is leaning towards more undervalued. So for example, we're going to look at when this indicator was quite incredibly stretched in a period of time. Now, on the 1st of September in the year 2000, that was the height of the tech bubble. And this indicator traded at 136.9%, which is significantly higher than the historical average of 75%. So I think that's a pretty good marker of where the market is highly overvalued. Another example of this indicator getting stretched was at the depths of the 2008 financial crisis, where the indicator dropped as low as 56.8%. So it's fair to say at that point it was a pretty strong buy signal and the market was going to go up from there. So we jump forward to the latest data in the USA, and the Buffett indicator currently sits at 144%, which is basically the highest it has ever been. So based on historical averages and looking at past data, it's easy to see that the stock market is incredibly overvalued. But I think we need to take a little bit deeper dive and have a look at some more data. Most people would look at this and go, the market is insanely overvalued. Sell, 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 sell. Sell everything. But let's have a little bit more of a look. So the Buffett indicator has had an upward trend over the past decades. I think this is something that's really important to note. So I think for a better measurement of valuations over time, I think it's really important to compensate for this uptrend to compare historically. Now, when we look at this next chart, what we see is the stock market is still quite expensive, but the stock market is nowhere near as overvalued as where it was in the tech bubble if you compensate for the upward trend in the average. So when we look at this indicator, it might indicate that the market, while still overvalued, is maybe not as overvalued as we think. So that's just one indicator. Let's look at a second indicator. Now, this next one we're going to look at is the forward PE of the S&P 500. So this is the expected price to earnings of the S&P over the next 12 months. The market is forward looking, so I think it's much better to go with forward PE. So once again, historically, the average forward PE of the S&P sits around 15 to 16. So I guess that's the point that you could call the market a fair valuation. During the height of the dot-com bubble, the forward PE of the S&P was 23.5. which I guess you would consider as highly overvalued. So what is it today? The current forward PE ratio of the S&P 500 is 20.4, and this is trading well above the historical average. So what is driving this buying of stocks and sending the market higher? I think what we have to do is we have to look at the time that we are in. We've had a major economic issue that's resulted in the shutdown of the global economy. Now, as a result, many sectors are looking at negative earnings. For example, the energy sector will undoubtedly have negative earnings. So this has really brought down the forward earning estimates of the S&P. But it's more than just that. There's a couple of things that are going on here. Valuations have clearly surged. The market has come up a very long way since the March lows, and there's been a precipitous drop in earning estimates over the next 12 months, not just in the energy sector, but across the broader market. So when you have valuations that are going up and earnings that are going down, that's going to increase the ratio. So in terms of this indicator, it really depends on how strongly the economy is going to bounce back. You know, whether it's like turning off a tap and then turning it back on, or whether the economy is going to have deeper problems over the next few years as a result. That is one thing that remains to be seen. The market has definitely priced in a V-shaped recovery and is hoping that everything is going to get back to normal very quickly. So strong earnings have been priced in for the next 12 months. So it's pretty clear that the entire market is banking on earnings coming back very strongly in the next year. So looking at these two indicators, is the market overvalued? Yes, but maybe not as much as we think. Should this affect our long-term strategy of buying great companies below fair value? Absolutely not. Not really. It might be a little bit more difficult for you to find those deals in the market when everything is a little bit more elevated, but as always, in every single market, there are deals out there. If you're an investor in index funds, should this change your approach? Absolutely not. I think you should continue to be investing small amounts every single week. The market may continue to go up, or the market might drop, but it's pretty much assured that over time, there's going to be a 7 to 8% increase every single year on average. Who knows? The market could go down next week and have a 20% drop. We would not have a clue. But consistency over time, I think, is one of the most important things that you can do in your investing. So even knowing market valuations might be a little bit stretched, they might be a little bit elevated, it should not change your strategy because it is consistency over time that ends up making you wealthy. So thank you guys so much for watching this video. If you really enjoyed the video and you found something useful in the video, then please make sure you like and subscribe to the channel and leave a comment about where you think the market is. Do you think it's undervalued, overvalued? I'd love to hear from you. So like and subscribe to the channel. Thanks for watching, and we'll see you later.